Hello and welcome to Views from the Market, Midmarket Private Equity and M&A in Canada. My name is Mario Nigro, and I'm a partner in the Private Equity and M&A group at Stikeman Elliott. For today's podcast, I'd like to welcome our guest, Rishi Dhir. Rishi's the head of Canada Transactional Insurance Solutions Group at Willis Towers Watson. Rishi, welcome. Thank you for joining us.
Thanks for having me on, Mario. I'm excited to be here.
Rishi, we always start by asking our clients to tell us a little bit about themselves, and obviously in your case, a little bit about the work that you do at Willis Towers Watson.
Yes, happy to. So Willis Towers Watson, Mario, is, as you know, a global insurance brokerage with a very strong local presence. I'm the head of Canada for our transactional insurance group here, but I sit as part of our broader North American M&A team. We're a full service brokerage. So as part of our team, not only do we help our clients procure transactional insurance solutions, meaning rep and warranty insurance, tax insurance, contingent liability insurance in connection with their M&A transactions, but we also help them with insurance and benefits diligence, as well as any go-forward insurance needs that they may have. We work with a variety of clients, including private equity, a number of private equity firms, alternative asset managers, as well as strategic buyers in order to help procure these kind of insurance. Before I joined Willis Towers Watson, as you know, I was an associate at Stikeman Elliott for just over 7 years. I did a lot of M&A deals, both on public and private side. And that's where I really saw the increased use of rep and warranty insurance. And that led to me transitioning over to Willis Towers Watson about a couple of years ago.
The evolution of rep and warranty insurance in Canada has been incredible because it used to be something we used to talk about only in a small amount of transactions. And yet, as time goes on, it's being used more and more for almost every kind of transaction. And I wanted to ask you, maybe just to kind of get a sense of where we're at with rep and warranty insurance. How often are you seeing it being used? What kind of transaction it tends to be used? So what are you seeing on the everyday in terms of, obviously it used to be a great product for the larger transactions, and that's where it got started. But as you pointed out, even in terms of the policies that you're putting in place, it's all kinds of different areas where you're seeing it used now. I want to get a sense of yourself on its evolution in Canada.
The adoption in Canada has definitely increased quite a bit. And there are a few reasons as to what led to that increase in adoption. So the first one, like you touched on, Mario, right on, we've seen this product that historically people would have said only really applied to those deals that were, say, in excess of $30 million enterprise value, and possibly even slightly higher in that, heights of COVID when there was real capacity limitations. Now we're routinely placing rep and warranty insurance on deals even as low as $5 million enterprise value. And that $5 to $20 million enterprise value market has really opened up for rep and warranty. And that's been really good for Canada because, as we know, there's a number of deals within that lower mid-market space that occur in Canada that just historically couldn't utilize the product. What has really caused the product to be able to apply to this market? There are a couple of factors for that. The first one is, over the last couple of years, we've really seen the premiums come down on the product. So at the heights of COVID, it wasn't uncommon to be placing rep and warranty insurance at premiums level, even 4 or 5% rate online. But over the last year, for instance, we were routinely doing deals in the mid 2% rate on lines. But for the lower mid-market, what's even more applicable are the minimum premiums that the carriers charge. So we have seen those minimum premiums come down quite a bit, and therefore making this product even more cost effective for that lower mid-market. Not only have the premiums come down, the deductibles under the policies have also come down. The one thing I do want to address for your listeners, sometimes I hear from individuals who are doing deals in the lower mid-market, is that just because my deal size is smaller, that I might be getting a narrower coverage from a rep and warranty insurance perspective. But the reality is that the truth couldn't be further. Just because the deal is a smaller deal or it's a larger deal, the coverage is just as broad. And we have really seen the coverage expand over the last couple of years. And you end up with similar types of exclusions as you would on larger deals, mainly around any issues that are identified in diligence or if there's any gaps in diligence. So all that to say that the applicability of this product for lower mid-market has really increased in Canada. And therefore, adoption in Canada has also increased. And secondly, the buyers and advisors, the knowledge base for this product has also gone up. And that has led to them being comfortable utilizing the product, recommending the products to their clients, all leading to a very positive environment for rep and warranty insurance in Canada.
Rishi, when we talk about Right, but warranty insurance, obviously, we think of it as being a solution for buyers to try to allow a deal to be done where sellers don't have to put an escrow or minimalist escrow. But in the lower middle market, I find it's even more attractive because as the purchase price is smaller, then it's even more accentuated and also to deal with some of the issues. And wanted to get a sense from you how you're seeing it used, because I know I've seen it used even as low as $1 million. It's wild where it's going. How are you seeing it used in these smaller deals? It used to be 5 and 10, but now I'm seeing threes and ones. And you can even get like really, really small. Like I just want to get a sense from you of how you're seeing it being used in the lower middle market.
Yeah, there's a couple of trends in the lower mid market. So typically on larger deals, a rule of thumb that buyers tend to use is we would get 10% of enterprise value in coverage. However, when it comes to the lower mid market, we are seeing buyers purchase a lot higher. So say you have a $5 million deal, we can see buyers purchasing even $1 million, $2 million in coverage, partially because the incremental costs are lower, but also because they're just able to sleep a little bit better at night, knowing that there's an insurance policy with a decent amount of limit on it, that if anything goes wrong after the deal has closed, they're able to claim against. In terms of deductible, broadly speaking, when we look at our data across North America, we're seeing that the no seller indemnity deals, what you will, commonly might call the walkaway type of deals, those deals last year sat at around close to 55 to 60% of the deals that we did. In Canada, if I were to just look at the Canadian numbers, that numbers is slightly lower, where we see there more often than not the deductible being shared between the parties, but still the walkaway deals, their percentages have also increased in Canada quite a bit. And whether you use a walkaway deal or not, from a rep and warranty insurance perspective, its implications have decreased quite a bit. Historically, we used to see a difference in premium, such that if the deductible is being shared between the parties, the premium was more attractive and a little bit lower than a complete walkaway deal. However, in the last couple of years, we have seen the premium between those two options really shrink. The difference between those two options really shrink. And in fact, there are a couple of carriers in the marketplace that price both of those options at the same premium level now. So there's no real difference when it comes to the premium on those deals. So we're seeing that, and that has really caused the no seller indemnity even in Canada increase.
For sure. We're seeing more people make claims under rep and warranty insurance. I mean, how is the claims history? People always say, what's the claims history like on these policies? What's your experience been on the claims history side in Canada?
Yeah, I would say the percent of claims that we see on our deals has stayed consistent at around that 20% mark. And when we look at some of the data from our carrier partners as well, I believe the market as a whole is seeing it around that 20% mark. Now, that doesn't mean that 20% of the policies are getting claims paid on them, because a lot of those claims notices that are filed are below the deductible under the policy. So they're filing it to start working through the deductible. And then once you're in excess of the deductible, that's when the claims are getting paid. But that 20% number has stayed quite consistent over the last couple of years.
If you look at where the market's going on RWI insurance, where do you think we're going to see more use of this product or an evolution of this product in terms of where the market's going? Any particular places you would say stand out where we'll see more of this, or people, obviously, like we said, we're seeing more of it in the lower middle market and in smaller deals, but any other places where you see it or you are seeing it be used more than it previously was?
Yeah, rep and warranty insurance it's a quite nimble product. And especially over the last 2 years, as the number of carriers in the marketplace have increased, meaning the capacity has increased, the rates have come down, the carriers are more open to being able to utilize rep and warranty in a variety of transactions. So to give you some examples, over the last year, we partnered up with a couple of carriers to create almost a custom rep and warranty insurance solution when it came to royalty transactions. So now we're doing rep and warranty insurance on pharmaceutical royalties, music royalty deals, where this product is being used routinely. We're innovating when it comes to minority transactions. So typically in a minority deal, say you're only purchasing 45% of our target, your losses under the rep and warranty would be prorated to your ownership percentage, especially at a target level loss. However, over the last year, hearing from our clients that this was not applicable for their scenarios, and they felt that the losses should be 100% covered given what's at stake for them, we were able to work with certain carrier partners to be able to obtain 100% coverage for even minority deals, especially around those 40-45% mark. We've also expanded coverage when it comes to distressed transactions. So say there's no real seller even standing behind the reps. Say there's a lender now that's in the shoes of the seller. And in a sense, those end up being what we would call synthetic reps. We're able to obtain coverage in those transactions. We've seen a drastic increase when it comes to real estate transactions where carriers recognize that maybe the risk profile is a little bit lower compared to an operating business. And therefore, we're able to price that product at a more cost-effective level than a typical M&A transactions and reducing the deductibles under those transactions. So the product itself is responding to the market and responding to the needs of the market in terms of being able to apply to a variety of deal structures and deal types. And I foresee that to continue. Now we're seeing, for instance, AI-specific reps being added in SPAs, whether that's AI-specific reps or just expansion of certain reps to account for the AI risks. And now we're routinely working with our carrier partners when placing rep and warranty insurance to gain comfort around those reps. So the rep and warranty insurance product, as well as the market as a whole, is quite nimble. We adapt very quickly in order to address the risks at hand of the day.
Rishi, I'm not going to ask you to tell me your secret sauce, but you highlighted, and I noticed it too, we're seeing more and more providers of this product. And obviously it's a more saturated market as the product grows. And can I ask, what do you see as the differentiator between the different people who are providing this product? And obviously you don't have to tell me your own secret sauce, but what do you say is where people like you are focused on in terms of driving service as the product continues to grow?
Yeah, that's a great question, Mario. And honestly, it's one that we think about quite a lot. As the market matures and more brokers enter the space, I think it's even more imperative for brokers like ourselves to be asking what really makes a difference for the client, what really moves the needle for them. And for us, it really comes down to three core pillars. It's our deep technical expertise, a mindset of innovation, and what underlies all of that is a client-first approach. On the technical side, we really pride ourselves in providing high touch and hands-on brokering experience for our clients. Our team is made up of former M&A lawyers like myself, as well as underwriters. So we're really able to anticipate issues before they become real issues. We can also forecast where underwriters may be focused on. We can also figure out where we may be able to create some leverage and overall how to structure the placement process in a way that gets the best results for our client. We've sat in the seats of people on the other side, so we can be proactive in a way that really makes the process smooth for our clients, resulting in stronger outcomes. On the innovation front, that's another big focus area for us. We've talked a little bit already about how we have pushed the product onto the royalty side, as well as expanding coverage on the minority deals. And those are innovations that we're constantly thinking about and trying to figure out how to push the product. We don't see ourselves being bound by precedent, rather are focused on really finding innovative ways to address the needs of our clients. And as I mentioned, what underlies all of that is a client-centric approach. And that's not just during the placement process, but it also on a post-closing basis. We find that the post-closing advocacy is just as important as the placement process. When a claim scenario arises, the client should be able to rely on a trusted broker who has the right expertise to be able to advocate on their behalf. And we have a dedicated claims individual who's solely focused on rep and warranty insurance claims and ensures that the clients feel supported throughout that claims process. So you're right. While there are many new brokers who may be entering the space, what we're offering is an experience and outcome that's materially different for our clients.
Rishi, you had mentioned earlier in terms of trends, obviously things like AI reps. And then I'm curious if you're seeing anything when it comes to things like tariffs, because that's a hot topic, the topic of the day these days. Are you more scrutiny going into things like tariffs for the purposes of coverage? And is there any other areas like that where you're seeing more scrutiny from rep and warranty insurance providers for the purposes of obtaining coverage?
You're absolutely right, Mario. Tariffs have definitely become a critical area of focus since they were first introduced earlier this year. And because of that, we're finding that we're spending more time with our clients upfront to help them anticipate where underwriters may want to focus on during the rep and warranty insurance process, as well as making sure the appropriate diligence is being conducted at the start of the process to avoid any surprises later on. There are definitely a few areas where we're seeing heightened scrutiny by the underwriters with respect to tariffs. One of them, as we can imagine, is customer diligence. Underwriters really want to ensure that they're aware of any customer pullbacks, any notice of terminations, any signs of potential decrease in order volumes. Another area is supply chain flexibility, whether alternate suppliers may be available from different jurisdictions if required. There's also a closer attention on compliance with import-export laws and looking at whether the target has appropriate policies and procedures in place to comply with any imposed tariffs. And underlying all of that is ensuring that the buyer has taken into account any impact of the potential tariffs in their valuation. It's worth noting that the scrutiny is not really just limited to cross-border deals, but also relevant for Canada-only transactions, especially if any of the suppliers are international or even if they have some customers that may be outside of Canada. So at the end of the day, the real takeaway for the buyers is to ensure that they're aware that there will be enhanced scrutiny in some of these areas with respect to tariffs and making sure that they're able to address these during their diligence and are really getting ahead of it, which will definitely allow for a smoother rep and warranty insurance process. In terms of some other focus areas that you asked about, we're definitely seeing an enhanced focus on condition of assets diligence as well as cyber diligence, even where it's a non-asset heavy transaction or it's not, say, a tech company. Both of those areas are definitely getting some heightened scrutiny depending on the nature of the transaction.
I always ask our guests a kind of crystal ball question. I mean, where do you see this going, this product, Rishi, when you look at its evolution in Canada? Is there other places in the world that have taken it further than we have that we can expect to see? Is there anything you think is coming in terms of potential future coverage or extending this product's reach? Is your thoughts on where you think this product can go?
For sure. Yeah. I'm excited about this product. Every quarter or every 2 quarters, we see some innovation happening with the product. So over the last year or so, we've been able to push the product such that we're getting no deductible for certain breaches of true fundamental representations. And that's been an enhancement in the product that did not exist before. Similarly, as we touched on, we have expanded coverage of the product to a variety of sectors where historically they might have been all priced the same. But now we're able to get specific pricing for those types of risk at our plate. So for instance, real estate or royalty deals, which are priced much lower than your traditional M&A types of deal. So I'm generally very excited about the product and its continued evolution because I think utilizing the product and working with brokers who are able to understand the needs of their clients will allow the product to continue to evolve in an effective manner and be able to address the needs of those clients as we go on.
Rishi, I want to thank you for joining us, for being our guest. It's great to hear about how this product, RWI, has evolved and how it continues to evolve and play an actual critical role now, not only in the big deals, but frankly, even in the middle market and lower middle market, it's become used regularly. And frankly, I expect that it's going to become the kind of majority use for most transactions as we go. So thank you for helping us to see where it's going.
Thank you so much for having me on. It's been a pleasure speaking with you.